Municipal bond sales fell to a 5-month low last week. Issuers were hesitant to come to market. Interest rates rose at the fastest pace since 2009. Joining us now is Corso. He's CEO at Cutwater Asset Management. He oversees $40 billion in assets, $5 billion of which is in munis. Welcome to InBusiness.
Glad to be here. Thank you.
So there's this tremendous debate happening about the reality of what's happening in the municipal market, and whether you're looking at states, whether you're looking at local governments, whether you're looking at project specific. Generally, though, do you think that municipal bond investors have been paid the right amount for the risk they're taking?
Well, it's for a formerly sleepy corner of the bond market, this has certainly lit up the news wires. I think it's really a tale of two cities, no pun intended. Whenever there's a market that's under what I would call fear and panic mode, often the way we like to look at markets in that condition is where are the opportunities and where indeed are the true risks to that market. And I would say, I wouldn't quite call it bifurcated, but there are some winning areas where you're getting paid more than you should perhaps, and there are areas where you do need to be careful.
So the challenge in always telling these stories about the municipal market is it seems so project specific and city specific here that coming up with a general thesis is oversimplifying it. So where are you seeing perhaps people being over rewarded for the risk?
Sure, and I think you hit a key point because there are tens of thousands of issues in the market, and it's a very localized market. However, there's another component of the market, the states, and geo paper, that I think you can look at that as an aggregate asset class.
General obligation.
General obligation bonds, yes. Of course, a big part of the municipal market. And here, again, is where I think maybe the baby's been thrown out with the bathwater. Just the panic and the fear, and as you mentioned, the amount of outflows from mutual funds has been so dramatic that virtually the whole municipal market has suffered. And we actually like the geo sector in terms of the risk-reward equation that's being offered today.
Do you expect defaults, and where would you expect them, and in what size?
Sure, I think it's certainly challenging out there. I think it's we do not expect defaults. First off,
on the
state geo level, despite the headlines and the fear and the panic around that. But it's really more down the food chain. Because as states try to repair their fiscal challenges, they're going to send less money down the food chain, as I call it, to smaller localities. And I think you will see clearly some issues and damage down below, a couple levels below. Maybe it's in areas where populations are flowing out, so they don't have the tax base. Subsectors of the municipal market, like non-essential services, areas that maybe were based on the project that's not doing so well. So I think those are the ones that you need to watch out for. But conversely, again, at the state geo level, we think it's a pretty attractive opportunity.
So there is a tremendous amount of noise, as you said. I mean, when you hear what's coming out of Washington, and Newt Gingrich, of course, got a lot of attention for saying that maybe states should be allowed to go bankrupt here. What's the biggest risk? I mean, is there a policy risk that you see as truly a threat right now?
Sure, I think that one is. I don't think it's a good policy. My opinion on that.
Allowing states to go bankrupt.
Allowing states to go bankrupt. I think the risk, and I'm not convinced that it will occur.
Right.
Virtually every state governor has come together and said, "Gee, we don't want this."
That's right.
Most major economists, or many major economists, have said this is not a good policy idea. So I don't think it'll occur. But the risk to it is the conversation around it. Just like, not to draw a complete corollary to what's going on in Europe, a lot of what happened in Europe became a self-fulfilling prophecy just because of the conversation around it. And I think if there's a risk right now, it's around the conversation, the perception, maybe not the ultimate reality.
So you'd say, please, Newt, stop talking, essentially.
Well, it's made them cheaper and a better attractive option.
You've been finding more opportunities there. Well, so. I was looking at your economic commentary, and right now, you're pretty much saying, I'll take anything but U.S. government paper.
Yes, we're very, very concerned about Treasuries in particular and the absolute low level of rates today, partly as engineered by the Fed for reasons that have been discussed ad nauseum, trying to help the economy. However, rates are so low that our concern is, as we look at the money being pumped through the system, looking a little bit further down the road, the potential inflationary impacts of that, in our view, portends higher rates as we move through time. So we don't want to have that price exposure in the Treasury market that exists as and when rates rise, because that could be a troublesome investment.
But do you think your view is widely held? I mean, you're not actually looking at bond offerings not being as successful as people hope, are you?
No, I think our view is becoming more widely held. We talked about it over a year ago, and I think if you talk to investors now, pretty much around the world, one of the number one, number two, number three concerns around our markets, U.S. Treasury market, is where are rates heading? And while the Fed can control the front end of that yield curve, and its Fed funds rate is virtually zero, it doesn't
and
really.
It's buying
and
debt
it's got
itself.
quantitative easing too,
right.
$600 billion. It really it doesn't have direct control over the longer end of the yield curve, and that's where the bond investors, quote, control the market. It's their view on what's a good risk-reward equation that dictates what the ultimate clearing level is for the yields. And as you mentioned, I think as we started, a very dramatic move up in rates and a very sharp steepening of the yield curve has occurred over the last 6 months.